Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I want to talk about the methodology and action. I want to show you what's left in the portfolio. And we're not seeing a whole lot of setups lately. That's okay. We're just riding out a couple of winners, which is always a good thing. And then I'm going to continue my series on Jesse Livermore. I finally come to the realization that there's so much there we probably would never get done if we tried to cover absolutely everything. But I did get through Reminiscence of a Stock Operator, so we're going to finish that up, and then I have some closing thoughts on that. Now, I do have some news, Arrivederci, just from this show, though. This is my last show. I will be still working with stock charts. In fact, now that the show is coming to an end, this will give me more and more time to make more appearances on more shows with stock charts. And I am still doing the weekend charts, which I have been doing probably for 20 years now. So that's not going away. It's just the Trading Simplified part of that. If you do need to reach me, here's all the information. If you want the slides from this show and all the other shows combined, you can go to davelandry.com/stock charts. Here's all my contact information. There's plenty of ways to get in touch with me. Every week I do a webinar, Dave Landry's Week of Charts, as I just said. I've been doing that for about 20 years, maybe a little longer. I stopped counting at 20 years, long before there was webinar software. But anyway, if you want to attend, those shows are usually on Thursday nights at 6 Central Time, davelandry.com/webinar. And again, here's all the other stuff if you want to reach me. All right, let's talk about the methodology in action. So we just have two stocks left in the portfolio, LFMD and KNF. Look at an LFMD. Again, this was a Landry Light pullback. This was pretty much a textbook type of setup, and I've been accused before of cherry picking my setups, and they're right. I cherry pick everything. Everything I trade, I cherry pick. So it's not just this one winner. We have other winners, and we also have some losers. And I'll show you a loser here in just 1 second. So anyway, it's a Landry Light pullback there, or the parameters down here for LFMD. 1,600 shares based on a 100K account. Entry of 425. Protective stop of 3. That seems like a long ways away, but this stock is very volatile, and that's what it called for, which gives us an initial profit target of 1.25 points, which puts that at 550. So let's take a look at what happened. Triggers, it looked like we were going to do okay, but then by the end of the day, it came back in. Our stop was down here. Initial profit target was up here. Now, one thing I pointed out a couple of weeks ago, in perfect hindsight, the market topped out on July 27th. And my mantra and my feeling is you need to see each position to its fruition. So if you're not stopped out, stick with it. You can see we did go sideways here for a long, long time. And the market during that time was actually rolling over, obviously. And of course, you ask yourself, is this dead money? Well, I don't worry about dead money. I'm not happy about dead money, but I don't worry about it because if you bail out early, you're never going to catch a trend. You just have to follow your plan. And the trailing stop is trailed higher once we get the initial profit target in, and then we stick with the position until and unless we get stopped out. And we let this trailing stop gradually loosen over time. You could say that also it's kind of dead money up here too because it's begun to trade quite sideways, but it still looks pretty good longer term. So we've been in this position, let's see, 1, 2, 3, 4, over 4 months. And although I'm slotted as a swing trader, I will stay with positions after they hit the initial profit target as long as they move in my favor. In this case, I stuck with it 2.5 months before it hit the initial profit target because that's what the methodology called for. Sticking with the position until stopped out. Now let's take a look at KNF. KNF was an IPO first pullback. Nice little thrust higher followed by a pullback. And then the parameters there. 300 shares per 100K account. Well, 299 technically, but obviously we'd round that up. Entry of 45.20, stop at 38.50. That's a 6.70 initial profit target and risk. And you add that to the entry, and that gives you 51.90. And you can see like the other one triggered and really didn't do a whole lot for a while, but also didn't stop out. It did, after 3 or 4 weeks, rally up to hit the IPT. And once again, in this particular case, in perfect hindsight, the market topped out on the 27th, but the stock took off in spite of the market heading lower. So the point is, again, see each position to its fruition. Now, we did eventually hit the initial profit target. At that point in time, our stop comes up to break even. That way, we are free rolling, so to speak. Little term I borrowed from my friend Charlie Kirk after he looked at my money management system. He called it free rolling once you hit that IPT and you get your stop to break even. I like that too. Anyway, I like hitting making profits. But you can see it did go sideways again, becoming another one of these dead money type of positions. But just yesterday, it was banging out some new highs with a bit of vigor, all-time high. So that's certainly a good thing there. Now here's the open portfolio. The numbers are a little bit different now live, but around these levels or so. You can see so far so good on these positions. 60 something percent profit in LFMD and 32% profit in KNF. Now we did have a losing trade. I don't want to make it look like we never had losing trades. CEIX. So we'll take a look at that one. I actually applied a little bit of discretion. I'll explain that. So here's a CEIX. It was a short. It made all-time highs. It sold off really hard. This is a first thrust. It's also a pattern I call reversal gap strategy. It was probably also a bow tie. A lot of these transitional patterns set up as more than one pattern. The entry was here. The protective stop was way up here, and the initial profit target was down here. And as you can see, after 1 or 2 days of being in the black, or 3 or 4 days, it went back into the red. Now, on Friday, which was the Friday after Thanksgiving, was a holiday. It was a holiday shortened session. Volume was thin. Market was choppy. It did technically hit that 105 level. So if you're following the system mechanically, as you should be, if you're newer to trading or new to the system, then you should have stopped out on that for a 2% loss. I decided to stick with the position. I noticed a few of my clients did the same thing. And that's because, again, it kind of shot higher, but then came right back in. A little discretion is okay. Don't throw caution to the wind, though, and then be up here at 112 and 115 and so on and so forth and still hanging on to a position like this, especially a short where obviously you can have unlimited losses, provided, of course, you keep putting more and more money up. So let's take a real brief look at the TFM 10% system. This system is based on a weekly chart using a 50-week moving average, and the measurements are based off of a 50-week closing high. And the thinking is, as long as you're within 5% of that 50-week closing high, the market's in pretty good shape. Once you drop below that, below that used to be 10%, but somebody pointed out that after 5%, the market often gets kind of iffy. The system still uses 10% though, and I'll show you the rules here in just 1 second. But anyway, so 10%, that's where bad things tend to happen. In this case though, it just tagged that 10% level and turned around and went straight back up. It happens. Let's take a look at the rules. You want to sell when the weekly close is 10% or more away from its 50-week closing high, and you close below the 50-week moving average. So here we had a recent sell signal. Unfortunately, the market went straight up, which is fine with me. I'd much rather be long than short a market. I can live with a whipsaw. As Greg Morris says, whipsaws are frustrating. Bear markets are devastating. You can survive frustration. So here's the buys. Buys are a little bit more stringent than the sell signals. The idea with the sell signal is to get out the way and then ask questions later. With the buy signal, you don't want to get whipsawed too much. So we need 2 bars of upside Landry light, meaning that the lows are greater than the moving average, and you have to close within 10% of the 50-week closing high. So here's the recent buy signal, and we're just shy of these new 50-week closing highs. So again, 2 bars of Landry light, bar 1, bar 2, and that completes the buy signal. You get a buy on the close, and it's based on a calendar chart for what it's worth. All right, let's continue and hopefully finish up our series on Jesse Livermore. Again, it went a lot longer and further than I thought. I'm drawing from Reminiscences of a Stock Operator and the biography and also How to Trade in Stocks by Jesse Livermore. Most of these presentations, as you likely know, have come from Reminiscence, and that book is just filled with a lot of knowledge. Now, when we last left off, he was still talking about manipulation. And some people said, well, what good is that, Dave? I can't manipulate the market. Well, just know that markets are manipulated and seek to get on the side of the manipulation. In other words, just follow the trend. When a stock keeps on going down, you can bet there is something wrong with it, either with the market for it or with the company. If the decline were unjustified, then the stock would soon sell below its real value, and that would bring in buying that would check the decline. As a matter of fact, the only time a bear can make big money selling a stock is when the stock is too high. So don't fight the tape, again, as he's preached over and over. And if a stock is going down, something's wrong. Don't try to justify, just get out of the way. And if you're a little bit more advanced, maybe look to short. So Livermore talks about the market being a discounting mechanism. Brokers should not dwell too strongly on actual conditions because the course of the market is always from 6 to 9 months ahead of actual conditions. Today's earnings do not justify brokers in advising their customers to buy stocks unless there is some assurance that 6 or 9 months from today, the business outlook will warrant the belief that the same rate of earnings will be maintained. So if you've ever bought a stock and then it had fantastic earnings and then imploded, now you know the market was expecting much, much, much better earnings. As a general statement, I would say ignore all news. Now, analysts and guys who scream on TV, they're always going to be bullish. And Livermore's point was, if the law were passed that would punish bull liars, as the law now punishes bear liars, I believe the public would save millions. So if you come out and say some bad things about a stock and it's not true, you can get in a lot of trouble. But it seems like you could say good things about a stock and it's not true and nothing happens to you. Now, Livermore, big on trends, obviously. The public ought to always keep in mind the elements of stock trading. When a stock is going up, no elaborate explanation is needed as to why it is going up. It takes continuous buying to make a stock keep on going up. As long as it does so with only small and natural reactions from time to time, it's a pretty safe proposition to trail along with it. But if after a long, steady rise, a stock turns and gradually begins to go down with only occasional small rallies, it is obvious that the line of least resistance has changed from upward to downward. Such being the case, why should anyone ask for explanations? Well, our trailing stop, that lets us know that the trend has likely ended, right? There are probably very good reasons why it should go down, but these reasons are known only to a few people who either keep those reasons to themselves or else actually tell the public that the stock is cheap. Now, at the end of Reminiscence, the version that I pulled from, which was shown earlier, there are a lot of selected quotes, and as I was trying to sum things up, I started looking at these selected quotes, and I think he pretty much nailed it. There's nothing new in Wall Street. Well, human nature is human nature. The greed, the fear, the next 1999, so to speak, that comes along, market's going to go straight up. The next crypto boom, crypto is going to go straight up. And then afterwards, we'll likely see a crash. Now, the most dangerous words on Wall Street are, it's different this time. And if you ever hear somebody say that, you need to run, not walk away. The tape doesn't care why. In other words, what is, as I often preach. Is the market going up? Is the market going down? Or is the market going sideways? What beat me was not having the brains to stick to my own game. Amen. So I just showed you a couple of stocks where I stuck to my own game because that was what I told my clients to do, and that's exactly what I'm doing. So I don't try to outsmart the market, at least not anymore. Now, in my own personal trading, sometimes I'll make some mistakes. I'll sweep them under the rug. But as far as what I'm doing publicly, I play my own game, and I don't get sucked into other people's game. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street, even among the professionals. Amen. Doing nothing is harder than it looks, and I think that was Ken Lambert who once said that. And a lot of trading is waiting. We're more waiters than traders, and I think it's been about 3 or 4 weeks in the trading service where I haven't recommended any new stocks, and I'm not taking any new position trades. I haven't taken any new position trades during that time, other than a token position in one of the IPOs we were talking about in Facebook. And that's the hard part, is waiting for your pitch, waiting for conditions to improve, waiting for the market. That's one of the hardest things when it comes to trading. And the reason it's so hard, and I asked somebody about this, and she's a psychiatrist who used to be a client of mine, and she explained to me that in real life, we as doctors and lawyers and automatic transmission mechanics, we can't sit around and wait for the ideal client. We have to take every client that comes along, and that's why a lot of people will deal in such mediocrity when it comes to markets. And Anthony Bourdain said the greatest sin is mediocrity, and I agree, and I'm going to flesh that out in upcoming presentations. A stock operator has to fight a lot of expensive enemies within himself. Amen. As I preach, there are a lot of extraneous influences when it comes to the market, and you could be your own extraneous influence. You need money, you want action, you're bored or whatever. I was making trades when I'd come in from lunch sometimes, and it's because before lunch I was hangry, and then after lunch I felt good and everything looked good in the market. That's actually called the hangry judge effect, based on judges who came back after lunch and gave more liberal sentences, as opposed to the judges who were hangry and gave very stringent sentences. Don't get angry or argue with the tape. Again, what is. Good luck with that one. The bottom line is, don't argue with the tape, though. If you get stopped out, you get stopped out. I allow myself F-bombs if stopped out, FYI. I'm way too emotional for this game. I'll come out and admit that. And I also have a psychological flaw. I have to be right. I scored very low, or not at all in some cases, in agreeableness on a personality test, something I'd recommend you do if you're going to be a trader, get to know yourself a little bit. And I didn't realize I had such an issue until I took the personality test. But anyway, that's one of the worst traits you can have as a trader, and that's why I have to use stops, and I have to get out when stopped out. Unless, of course, I'm doing a little discretion, not talking out both sides of my mouth, but using a little discretion like I showed earlier. Speculation is a hard and trying business. Amen. And the speculator must be on the job all the time, or he'll soon have no job to be on. Yes, there are so many things. I missed a huge trade a few weeks back, and it's killing me. And you just have to do your homework every day, and you have to keep chipping away at it. You also have to take your lumps. If you get stopped out, you get stopped out. The game taught me the game, and it didn't spare the rod while teaching. So what he's saying here is you actually do have to trade if you want to learn how to trade. And believe me, there are a lot of lessons that have to be learned, and a lot of those lessons are painful. They say you never grow poor taking profits. No, you don't, but neither do you grow rich taking a 4-point profit in a bull market. So my whole methodology is based on the occasional outlier. So those two trades I just showed you that are still open, maybe they'll turn into those outliers. And those outliers, occasionally you'll catch one, and it might go 300, 400, maybe even 500%, and that can make your year, obviously. There was a person in the offices that they call turkey or turkey neck, because he looked like a turkey and he strutted around the office kind of like a turkey, not intentionally, but he was an older gentleman. And whenever he was asked about a stock, he would say, well, you know, it's a bull market. So that's the way you need to look at it. If the market's going up, then it's a bull market. If it's going down, it's a bear market. If it's going sideways, it's a sideways market. Men who can be both right and sit tight are uncommon. That kind of dovetails with my dead money reports and the two examples I just showed you. Both of those stocks were dead money for a long, long, long time before finally, thank goodness, taken off. And it's very hard to sit tight during that period where the market's just grinding back and forth. And based on the Facebook posts from my clients, I could tell that a lot of these guys and girls got tired of sitting in these stocks and bailed out early. And it's hard, believe me. And that's the one thing about me doing the trading service, is it forces me to practice what I preach. A man can see straight and clearly and yet become impatient or doubtful when the market takes its time about doing as he figured it must do. Well, I thought both of those stocks were going to head higher in a big way, and both of them did, but they went sideways for a long, long time. First, disregarding the big swing and trying to jump in and out was fatal to me. So early on, Jesse Livermore was in and out in the bucket shop. So once he got to the real market, he found out that he couldn't trade like that. Nobody can catch all the fluctuations. In a bull market, your game is to buy and hold on until you believe that the bull market is near its end. Amen. Every now and then I'll look at these positions that have done extremely well, and then I wonder why I do any other trading, because it sure is a lot easier to just sit back and let things unfold than it is to be like the rat going for the cocaine, in and out, in and out, in and out. One of the most helpful things that anybody could learn is to give up trying to catch the last eighth or the first. These two are the most expensive eighths in the world. So years ago, most of you are probably too young to remember, but stocks used to trade in eighths. So basically what he's saying is trying to catch a bottom or catch a top is very, very expensive. I don't buy long stock on a scale down, I buy on a scale up. So he waits for stocks to move higher. As I've preached 1,000 times, I'll recommend a stock, it won't trigger. 6 months later, somebody will email me and say, hey Dave, what do we do with this turd? And I'll argue that I would never recommend that stock because it's going straight down. And then we back the chart out 6 months. And I'm like, yeah, I did recommend that stock, but it never did trigger. So people want to buy early thinking they're getting a bargain, but in reality, they are not. You want to buy things that are going up. If they don't go up, don't buy them. The bear side doesn't appeal to me any more than the bull side or vice versa. My one steadfast prejudice is against being wrong. Amen. I prefer a bull market because it's much easier to trade, but I'm not afraid to short stocks. And as I've said 1,000 times before, my friends who run a lot of money and are long or only oriented, because that's the way the charters were set up, they always kind of tend to see the market as glass half full. And usually they're right, because there is a longer term upside bias to the markets. Doesn't mean that the market can't go down 50% every now and then, but as a general statement, they're right because the market does go higher. But they tend to, again, kind of always see the market as glass half full versus half empty. And that's just the way their charters were set up. I believe that if they were actually shorting, there would be times when they would actually turn bearish. So I think it's a good idea to short. You're not going to get rich shorting, but it does help you to see both sides of the market. The only thing they do when a man is wrong is to be right by ceasing to be wrong. Now, this doesn't mean get out of a position that's not working, okay? As I just showed you, we stayed in positions for weeks and even months, even though they weren't really working. The point is, if you're supposed to be in a market because you're not stopped out, then stay in the market. If a man is both wise and lucky, he will not make the same mistake twice, but he will make any one of the 10,000 brothers or cousins of the original. My mistake family is so large that there is always one of them around when you want to see what you can do in the fool play line. So you don't want to make the same mistake twice, obviously. A mistake made twice is a choice, but there will be many cousins of, so as Mr. Livermore has pointed out, mistakes have many relatives, so be careful not to make a similar mistake is his point there. Losing money is the least of my troubles. A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. As I often write, if you do something stupid in the markets, it affects you mentally and monetarily. So it monetarily, by being wrong, you feel bad about it. And then also because you lost money, then you feel bad about losing the money. So make sure you honor your stops. Know that losing is part of the game, but what I would recommend you do is be super, super selective going in. The trend has been established before the news is published, and in bull markets, bear items are ignored, and bull news exaggerated, and vice versa. So Livermore knew many, many years ago that news is noise. And again, a bull market will shrug off some really bad news and a bear market will shrug off some really good news. A man has to guard against many things, and most of all against himself, that is, against human nature. And this is why I preach trading psychology so much. The trading mechanics are fairly simple. It does take some experience, but most people go on a grail hunt. Most people try to catch bottoms and catch tops and all these other bad behaviors that I'm often discussing. So you have to guard against human nature. In a narrow market, when prices are not getting anywhere to speak of, but move within a narrow range, there is no sense trying to anticipate what the next big movement is going to be, up or down. Amen. I do a little intraday trading, probably more than I should. And lately, we've just been chopping around in a very, very, very narrow range at these sort of high overbought levels. And I'm thinking that we're going to have the mother of all corrections from overbought. Well, that correction hasn't come, and I'm in there trying to catch that big move. So I need to heed what Mr. Livermore says, and when the prices are in narrow range, just chopping around, sit on my hands. The speculator's chief enemies are always boring from within. That's one of the most classic lines that Livermore ever said. Amen. We have found the enemy, and he is us. I think that's Pogo. A man cannot be convinced against his own convictions, but he can be talked into a state of uncertainty and indecision, which is even worse, for that means that he cannot trade with confidence and comfort. So you have to be fully committed and fully confident in what you're doing. If you're wrong, your stop will take you out, okay? And if you're not happy that you got stopped out, and we never are, believe me, then work to make better decisions in the first place. It cost me millions to learn that another dangerous enemy to a trader is his susceptibility to the urgings of a magnetic personality when plausibly expressed by a brilliant mind. So he had a position but allowed himself to get talked out of it, and it cost him hundreds of thousands of dollars, if not millions. So once you are committed to a trade, stay committed to that trade until you are stopped out. Now, on the next trade, especially if those other trades aren't really working out, make sure you're super selective. Make sure you're looking at the overall market to make sure it's headed in the right direction, and make sure the sector and stocks within the sectors are also headed in the right direction. Stack the odds in your favor. The hope of making the stock market pay your bills is one of the most prolific sources of loss in Wall Street. There isn't a man in Wall Street who has not lost money trying to make the market pay for an automobile or a bracelet or a motorboat or a painting. So you have to trade like you don't need the money. And when the market is kind of chopping around like it has been lately, and we're waiting to see if the correction ever comes, and then we're waiting for setups, it's very hard, especially when you need money. And let's face it, especially nowadays, we always need money. So you really have to be careful when you need the money. The market really doesn't care about your needs. I recently met a young gentleman, and at first I thought he was like a little rich kid, because he's like, oh, I want to trade and I'm all into it and everything. I was like, well, good for you. And then I later found out that he was hoping to pay his rent through his trading, and trading a very small account and using a prop firm. And the last time I saw him, things were going a little bumpy, and I tried to tell him that it's going to be really hard to pull money out of your account every month that rent is due. You're going to have to figure out a way to have a separate account where you can't touch the money. A market can and does often cease to be a bull market long before prices generally begin to break. Now, that's going to come in handy every so often when the market begins to top out. If you can't find a setup to save your life and shorts begin showing up, then you might just have a market top. I remember apologizing to my clients, and I believe it was October or so of 2007, because I couldn't find a long to save my life, even though the overall market was still at new highs. But I was seeing short after short beginning to set up, and that all made sense a few months later when the market began to tank. So pay attention to the overall market. Pay attention to what a lot of stocks are doing. I look at 2,000 stocks every night. Years ago, it took me a few hours to do that. Now I can do it in about 30 minutes if I don't interrupt myself or let myself to be interrupted. either one. I probably interrupt myself more than others interrupt me when it comes to that. But the bottom line is, in going through all those stocks every night, I have a pretty good feel for what's going on within the overall market. In a bear market, it is always wise to cover if complete demoralization suddenly develops. So his point there was, if you're a big player and you have a lot of stock to buy and then the market just absolutely comes unglued, it's the end of the world and just nobody wants stocks or whatever, that's actually a good time to start covering. That'll only affect you every 10 years or so, or whenever we get in the bear market and things just really get ugly and you get that last final push down. Now, I will continue to trail stops, and just in case it keeps on keeping on. But again, if you have complete demoralization, then that might be a good time to cover. Let's say you were, I'm just thinking randomly here, but like remember GameStop, these hedge funds shorted it forever, and it got really, really cheap, and they probably could have and should have covered at those super, super, super low levels, or at least scaled out. But then they didn't, and then they got caught in a really bad short squeeze. The principles of successful stock speculation are based on the supposition that people will continue in the future to make the mistakes that they have made in the past. Now, that's by a gentleman named Woodlock. The point here being that in a rip-roaring bull market, there's going to be this huge euphoria, and stocks are going to get crazily overvalued. That's okay. Just follow them higher, have a stop in place, and then the market will crash shortly thereafter. But in between, just remember, as I believe Mr. Keene once said, markets can stay irrational a lot longer than you can stay solvent. There's no question that advertising is an art, and manipulation is the art of advertising through the medium of the tape. The tape should tell the story the manipulator wishes its readers to see. So again, there's Livermore talking about manipulation, but his point is that if you're paying attention to the trends, you could be on the right side of the manipulation. Now, here's a big one. The public ought to always keep in mind the elements of stock trading. When a stock is going up, no elaborate explanation is needed as to why it is going up. It's either an uptrend, it's either a downtrend, or it's either going sideways. I have a big tattoo on my arm that says just that with 3 arrows, one going up, one going down, and one going sideways. So again, don't confuse the issue with facts. What is, is. It takes continuous buying to make a stock keep on going up. As long as it does so with only small and natural reactions from time to time, it is a perfectly safe proposition to trail along with it. But if after a long steady rise, the stock turns and gradually begins to go down with only occasional small rallies, it is obvious that the line of least resistance has changed from upward to downward. Use something like Landry Light or bow ties and all these other things that I preach, and of course the net price change, and look at the charts to see if the trend may be turning. Such being the case, why should anyone ask for explanations? There are probably very good reasons why it should go down, but these reasons are known only to a few people who either keep those reasons to themselves or actually tell the public that the stock is cheap. The nature of the game, as it is played, is such that the public should realize that the truth cannot be told by the few who know. So what is, don't confuse the issue with facts. Well, I want to thank everybody for watching my show. I hope you enjoyed this series. I think we had about a 4-year run here or so that's pretty exciting. I'm not going away, though. You can still reach me at daviddavelandry.com and all those other links that I showed earlier. And again, every week I still do a live show, and that's at davidlandry.com/webinar. You can also catch me live on YouTube. I want to thank everybody for watching, and may the trend be with you.